Welcome back. Shares of automakers and auto parts makers are under pressure on the latest news on tariffs from Donald Trump. But our next guest says it may be a knee-jerk reaction. Let's go to an expert. He's James Demmert, Chief Investment Officer at Main Street Research. James, thanks a lot for joining us. We know very well from the last time that Donald Trump threatened trade action against Canada that the North American auto sector includes parts and vehicles crossing borders many times before they are completed, not just this border, but the Mexican border as well. Are investors correct to be alarmed at the potential of a 25% tariff placed on Canada and Mexico?
Happy holidays, Paul. Good to see you. I think that investors should be concerned. There are beneficiaries and victims of Trump's tariff policies, and he is going to probably do what he said. I do think that the domestic automakers, the Fords, the GMs, they got some weakness here. That probably is knee-jerk. They're going to be affected without question because they have parts made in Mexico. They sell to Mexico and Canada, but they're not the big risk here. The big risk is obviously the foreign auto makers and the tariffs that we're going to be putting on them. So I think the domestic, you see some weakness here. I am not so sure the auto industry is a place anybody should go in general as an investor, but I do think the current weakness in the U.S. auto is probably temporary. They're not as much a victim as some of the other automakers outside of the U.S.
Okay, and we're just looking as you speak at a dramatic reaction. GM stock down close to 7%. What about auto parts makers? We've got some big ones in this country, Linamar, Martin Rea, Magna International.
Yeah, and Borg Warner, another one. A lot of these are supplying to EV markets. This is the tariff policy is a negative. Obviously, global trade is what makes all countries, all companies be more profitable. In the short run, however, we probably will see the parts makers in the U.S. be more of a beneficiary than a victim. So, in fact, if we were going to be in the auto industry, which we're really not, we would be more for the parts makers like the ones you mentioned, or maybe a Borg Warner. We think they're going to be protected here in the U.S. That would be a beneficiary, probably more than a negative.
Okay, you do see opportunities not in this sector. You've said a couple times that you're not in and you wouldn't advise investors to move into auto stocks right now, but you do see opportunities in technology, telecom, and financials, among others. Why so?
Yeah, it's a new business cycle led by the AI trend without question. And that's really where economic growth is. This market traded first on the Fed lowering rates. Going forward in 2025, it's going to trade on earnings. That's really what drives stocks as we get into this new phase. And that's where you're going to see in telecom, in technology, think of Trump's deregulation helping financials in the industrial sectors with more all kinds of projects we have for infrastructure. So we see a lot of very attractive sectors based on earnings growth and some policy changes.
We promised viewers that you would talk about Constellation Energy and why you like that stock. CEG gets a lot of attention. It's a provider of nuclear energy. Obviously, it gets a lot of attention based on the AI theme and the huge power demands of companies developing their artificial intelligence capabilities.
Yeah, it sure does. And if you're an investor and you're scared to buy NVIDIA or any of these AI plays that have gone up tremendously for good reason, you kind of go to what I would call a second derivative of AI. And Constellation's a great example. We are gobbling up more electricity because of AI, also the EV market. So the electrical grid just isn't big enough, not just here in the US, but globally. Constellation comes with a solution. What they really do is they build out utility grids, provide energy from different sources. It's a great way to play what I call a very important theme for this business cycle. Let's expand the grid. And CEG is an excellent way to do it. 25 times earnings. I don't think investors really have recognized it fully. We think it can do very well next year. They just had a wonderful contract with Microsoft to provide a lot more energy for their server farms. And from where else but 3 Mile Island, the nuclear transplant plant down there in Pennsylvania. So we love CEG here. Great way to play a very reasonable multiple in an AI play.
Okay, another stock you like is ServiceNow. It's a provider of information technology and cloud computing services to other companies.
Yeah, this is another adapter. You know, if you don't want to buy the picks and shovels of the semiconductors, this is a company that bought most of the stuff from NVIDIA and other semiconductors, basically to power this enterprise grid that they provide for companies that does just about everything they need. So ServiceNow is a wonderful way, what we call second derivative. They've put a lot of money into AI. We think it's going to come out tremendously, already has last quarter. Over the next 4 quarters, you're going to see a lot of productivity growth coming from AI. Really not having to increase infrastructure, but using that technology to lever profits. Trading at basically the growth rate of earnings, so reasonable here even for investors. And into any choppiness certainly would add to the stock or the CEG.
Okay, let's finish with Regions Financial. It is a regional bank. It got pummeled back in the Silicon Valley, the era of the Silicon Valley fiasco, but has done much better since then and is now trading at a multi-year high. Why do you like RF?
Boy, Paul, they really did. They threw the baby out with the bathwater during the meltdown of the banks. But you know, there's a few things going for regionals. One is you got the Fed finally putting the gun down of raising rates. And the Fed's now going to be moderate or accommodating with interest rates. That's hugely beneficial to regions' net interest income. But also, you know, on top of that, there's the animal spirits of deregulation, which really focus in on the financial stocks, and the small regional banks like Regions is an excellent example. That whole sector has not done anything for a few years. We think there's a lot of value. Regions the best way to play it at 11 times earnings. So a wonderful position for 2025.
Thank you very much, James. That's James Demmert, Chief Investment Officer at Main Street Research.